Hello and welcome to the Weekly Outlook at XM.com. I'm Maria Bashardis, and joining me is Senior Investment Analyst Rafi Boyadjian. We'll be taking a look at the week ahead. So Rafi, let's begin over in Japan. Virus cases are rising again, and if several regions are placed in a state of emergency, we could see a decline in business activity. How is Japan's economic recovery going, and what are we likely to hear from the Bank of Japan when it concludes its two-day policy meeting on Tuesday?
Well, Maria, Japan's recovery has been fairly solid. We've seen a strong rebound in exports, and that's helped the recovery in Japan, even though domestic consumption has been much more muted. But nevertheless, Japan does have the smallest output gap among the G7 nations. However, now Japan is being swept by a fourth virus wave. And on top of that, Japan's vaccine rollout has been rather slow. So there is a danger to the growth outlook, but the Bank of Japan is optimistic. They are expected to revise up their growth forecasts in their latest outlook report when it's published next week. Inflation, though, has been much more subdued. Now we are seeing, of course, an uptick in inflation in other Western countries, but in Japan, inflation we haven't really seen a notable rise in inflation, and the Bank of Japan is expected to lower their forecasts for the current financial year. Now, as far as the monetary policy is concerned, we're not expecting any changes by the bank. We did see those tweaks at the last meeting. They made some changes to their various monetary easing measures to make them more sustainable. Now, that was a sign that the Bank of Japan will stay on the current policy path for some time to come. So even if we do see over time in the coming months, some improvement to the outlook or some worsening to the outlook, it's not going to change policy by the Bank of Japan. So as far as the yen is concerned, we're not expecting any reaction next week. In fact, the yen is mainly being driven by yield differentials. Now, of course, the Bank of Japan has its yield curve control policy, which caps the 10-year yield around 0%. And now we're seeing this surge in yields in other countries. The Japanese yields have remained pretty much where they were before, and this is pressuring the yen against other currencies. But this is, of course, good news for policymakers because a weaker yen is beneficial for the Japanese economy. So those fundamentals aren't expected to change, and so we're not expecting to see much of a reaction by the Bank of Japan policy meeting.
Okay, moving over to the Eurozone now. The euro has done well this month, but it now seems to be losing momentum. How might next week's flash GDP estimate affect the euro?
So it's been a very strong month so far for the euro. So it has lost perhaps some momentum in the past few days, but it's too early to judge whether or not the rebound is over or is coming to an end. Now, although this rebound has mainly been driven by a weaker dollar, we are seeing improved fundamentals for the euro area economy. The EU's vaccination program is gathering pace, and that bodes well for for growth in the next few quarters. We've also seen much stronger than expected PMI numbers out of the euro area, and that reflects a much more resilient economy than we saw, say, last year when we had those lockdowns. So we are expecting a strong rebound in the second quarter, and investors might choose to focus on that rather than on the first quarter data that's coming up next week. The data will probably confirm that the Eurozone is in fact in a double dip recession. Now, how the euro reacts will probably depend on what's going to happen to the dollar, because if we do see the dollar rebounding next week, perhaps on the back of strong US data or the Fed, that could pressure the euro, and if that coincides with the GDP release, and the GDP release is rather grim, we could see the euro dipping lower. On the whole, though, any such move would probably be temporary, and as the Eurozone outlook improves, the euro could potentially extend its rebound.
And finally, the U.S. economy is doing well, having benefited from 2 months of fiscal stimulus. Next week's economic calendar is packed. What what are we likely to get from the data, and what are we likely to hear from Fed policymakers after they meet on Tuesday and Wednesday?
So we will see a barrage of US data on top of the Fed meeting. At the start of the week, we've got durable goods, consumer confidence, but the main focus will be on the preliminary GDP data that's coming up on Thursday. As you said, we had 2 rounds of fiscal stimulus, so all of that should have boosted GDP growth in the first quarter. Now the estimates for annualized growth is for 5.7%. We could even see a figure of 6%. And then on Friday, we've got personal income and personal consumption. Now, personal income probably soared by 20% in March because, of course, we had the 3rd stimulus checks being distributed in March. From Biden's relief package. Consumption, that's a bit harder to predict because there is some evidence that consumers are perhaps saving more and not spending as much of their stimulus checks than they did on the first and with the first and second checks. But nevertheless, the data overall is expected to be very strong, and that could potentially lift treasury yields. Treasury yields have been drifting lower during April because markets have started to believe the Fed when it says that they're not about to begin tapering and that if there is an inflation spike, it will be temporary. But if the data does keep getting stronger and stronger, eventually, we could see the bond sell-off resuming and treasury yields jumping higher and boosting the dollar. If that happens, though, it will probably happen after the Fed meeting because on Wednesday, we're not expecting any changes from the Fed. In fact, Powell and his colleagues have been fairly consistent in what they've been saying. We've seen actually we've seen a barrage of Fed officials making speeches over the past month or so, and they've all been saying the same thing, that tapering is a long way off. They're not going to do anything until the economy is closer to full recovery. Inflation surge will be temporary, so there's nothing to worry about. And the Fed, in fact, has become so dovish that some market participants are more worried about an overheating economy than the Fed actually is. So we have to have in mind that there could be something that could trigger some panic in the bond markets, and the Fed will be able to maintain calm for only so long. Will that happen next week? Well, you never know. But for now, the dollar remains fairly. It's been on a downtrend. It has started to stabilize, but we could see much more volatility next week from the Fed meeting and, of course, the data.
Rafi, thanks so much. And thanks for joining us at xm.com.